Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Tuesday, everybody. 2 quick pieces of housekeeping. First, it is likely that there will not be an episode tomorrow, Wednesday, as I will be travelling internationally and there will be no time to record. The second piece of housekeeping is that this episode will contain sponsored content. Sponsored content is included twice per month. This ensures that the channel is financially sustainable while still primarily supported by subscribers like yourself. The sponsored content will be clearly labelled, is easily skippable, and for details regarding how I work with sponsors, please see the description below. Okay. Let's move into the episode, and we begin with US-China developments. Yesterday, Monday, General Secretary Xi Jinping met with US Senate Majority Leader Chuck Schumer and his delegation in what commentators argue is a clear sign that Xi Jinping intends to visit the US next month for APEC. Now, these meetings are both rare and somewhat surprising. Quote, "This reversed the communication mechanism between the US Congress and China that had been stagnant for many years. Although Congress has relatively little power in foreign policy, Schumer can personally understand China's intentions through the visit and convey them to Congress, which is of positive significance." End quote. According to state-run Xinhua, during the meeting, she underlined that the China-US relationship is the most important bilateral relationship in the world, which will, quote, "determine the future of humanity," end quote, adding, quote, "the two countries should properly handle their relations, respect each other, coexist in peace, and pursue win-win cooperation." End quote. The same day, Schumer's delegation also met with China's top diplomat Wang Yi, who, quote, expressed hope that the lawmakers will gain a more accurate understanding of China, view China in a more objective way, and manage differences in a more rational way, so as to play a constructive role in bringing bilateral relations back onto the right track. End quote, in the words of state media. Now turning to the Anglophone commentaries on the meetings, US-based Wall Street Journal writes that Schumer raised several issues with Chinese leaders in Beijing. These included pushing for a more level playing field in China for US companies and workers, targeting Chinese companies that sell chemicals used in the production of the narcotic fentanyl, ensuring China doesn't provide support for Russia's war in Ukraine, and pushing for greater human rights in China and the release of American detainees. Schumer expressed, quote, "We made a number of specific requests. Now that we've established these relationships, we're going to pursue them." End quote. The Israeli-Hamas conflict was also raised, with Schumer telling Xi directly yesterday, quote, "I urge you and the Chinese people to stand with the Israeli people and condemn the cowardly and vicious attacks upon them." End quote. And he was even more blunt with Wang Yi, who he said showed, quote, "no sympathy or support for Israel during these tough, troubled times." End quote. Iran was also raised. Schumer told reporters after the meeting on Monday, quote, "A bunch of us made the request that China use its influence in Iran to not allow the conflagration to spread. She said they have influence with Iran in many different ways, and we asked them to do everything they could." End quote. Like I said, these meetings are a strong sign that Xi Jinping will travel to the US next month. US-based The Washington Post quotes an unnamed senior official as expressing, quote, "It's pretty firm that there will be a meeting. We're beginning the process of planning." End quote. And this week, US President Biden expressed, quote, "There has been no such meeting set up, but it is a possibility." End quote. Next up for US-China developments, several reports suggest that updates to the US semiconductor export controls on China from October last year are about to be announced, and that they may be tougher than industry and analysts initially anticipated. The wisdom and effectiveness of semiconductor export controls have become a topic of debate in US policy circles in recent months, especially since the release of the new Huawei smartphone. Quote, "The United States has incurred essentially all the costs of an aggressive export control policy toward China, but it has done so in a way that does not provide all the potential strategic benefits of actually constraining China's future technological capabilities. The US and allied approach does appear to have limited China's access to nodes more advanced than 7 nanometers in economically competitive terms, and more advanced than 5 nanometers in absolute terms. It is possible that China's extremely expensive efforts to indigenize everything will prove to be a strategic error, forcing China's government to perpetually subsidize an often corrupt semiconductor industry that produces products that are uncompetitive in Chinese or global markets. Such was the case with the Soviet semiconductor industry. However, it is also possible that China's domestic champions will ultimately achieve some degree of financial sustainability, driven by partially or fully protected sales in the large Chinese home market, as well as successful exports abroad. Such was the case with China's automotive and solar cell manufacturing industries." End quote. The lobbying power of corporate America is relevant to this conversation too, and big chip makers are pushing back on Washington's China agenda on this front. US-based New York Times writes this week, for example, that since July, Nvidia, Intel, and Qualcomm, three of the world's largest chip makers, have pressed their case that cracking down on China would have unintended consequences. They have challenged the White House's national security wisdom in meetings with officials like Secretary of State Blinken and Commerce Secretary Raimondo, wooed think tanks, and urged leaders across Washington to reconsider additional chip controls. The companies have warned, writes the outlet, that a US pullback could accelerate China's development of an independent chip industry, paving the way to a world dominated by Chinese-created chips rather than American-designed ones. Indeed, the US-based Wall Street Journal reports too that Washington has been working to close some loopholes in the restrictions that have allowed US companies to keep selling to their Chinese customers, and that this has been a complicated process as, quote, administration officials have dealt with lobbying from US business interests and an internal debate over how tough to be on Beijing in the weeks leading up to the potential summit with Xi, end quote. The outlet writes that some officials have argued that publishing the updated rules or taking other actions might prompt Xi to cancel. Quote, US officials worry that tensions could spiral into conflict, particularly over Taiwan, and allies, many of whom count China as a top trading partner, have urged the administration to steady ties with Beijing. End quote. However, despite these concerns, the outlet continues, citing unnamed sources, the administration has decided to nevertheless press ahead with the export control updates and other actions, quote, to set the tone in relations with Beijing and show that it isn't pulling any punches in advance of a summit. End quote. We all know that the world is going through a period of tremendous political and social change. Almost 2 years ago, global energy markets changed forever. The war in Ukraine pushed Europe to engage in the largest energy shift in generations, and at a continental scale. One of the outcomes of this shift has been the renewed serious consideration of greatly accelerating nuclear power investment. We know that China has been investing heavily in the sector too, but where the most seismic changes are happening is in North America. This is where massive opportunity lies. Back in the 1990s, laws and regulations heavily restricted US uranium exploration and mining. However, incredibly, the US is a massive consumer of uranium, one of the biggest in the world, and this trend is set to continue. Now Washington has a bipartisan consensus to remove these restrictions. Bringing back uranium supply chains to North America is now a national security priority. Surging demand from Europe, China, and the US has meant that uranium has entered a very strong bull market, with the price of U3O8 going from under $20 a pound to nearly $70 a pound. The global ex-uranium ETF is up almost 40% in the last 12 months, and up over 260% since its March 2020 lows. And today's video sponsor, Ather Energy Corp, provides investors with an incredible opportunity to take advantage of this historic shift. Ather Energy Corp, Ather, is a mineral exploration company focused on the acquisition, exploration, and development of mineral resource properties. Ather holds the largest cumulative exploration package in the Athabasca Basin, the world's most prominent basin for uranium discoveries, with a massive 3.4 million acres of land. Their land package is very impressive, the result of more than 20 years of staking and accumulating land back when uranium was very much out of favor, by founding members Matthew Mason and Timothy Young, prospectors that are considered the most successful in the past decade in the basin after providing the seed land for the discovery of several world-class deposits. These two men own 30% of the company, so they very much have their skin in the game too. Ather Energy Corp also has a 10% carried interest portfolio of claims operated by NextGen Energy Limited and ISO Energy Limited. The company has a whopping $25 million in cash on hand, which means they can conduct exploration efforts for years on end, and they can afford to take their time and diversify among their millions of acres. They will soon start drilling too, which could mean huge upside potential. If successful, having a piece of this company is like holding a long-term option on the Athabasca Basin, the richest grade uranium region in the world, as the world turns more to uranium. This is very much an exciting and unique pick. So, Atha Energy Corp has a massive cash position, a huge land package in the right place, a strong leadership with proven experience and results, and a growing bull market for uranium. This could make an excellent addition to any well-diversified portfolio seeking to take advantage of these historic shifts we are seeing in energy and commodity markets. We remember that all investment involves risk. This is not individual investment advice. Always speak to an investment professional before making any investment decision. A big thank you to Atha Energy Corp for sponsoring this episode of China Update. We're now returning to regular content, and next up we move through economic developments. Yesterday, Monday, Evergrande's international bond investors in a joint statement said that the company's last-minute cancellation of a restructuring affecting more than $19 billion of its international bonds could lead to a collapse for the company and have a catastrophic effect on other developers. We remember that the housing giant abandoned a bond restructuring deal 2 years in the making late last month after regulators had barred it from issuing new securities. The investors' statement expressed that this was quite peculiar, adding, quote, "This will likely lead to the uncontrolled collapse of the group," end quote. Evergrande had more than $332 billion in liabilities by June, which included money owed to suppliers, unfinished projects, and its bond and loan obligations. Evergrande's shares fell 13% yesterday, Monday, seeing a 4-day losing streak. Quote, "The ongoing uncertainty and lack of transparency surrounding Evergrande and its executives have exacerbated the nervousness and negative sentiment in the Chinese real estate sector," end quote. Chinese property companies defaulted on a principal amount of around $30 billion last year, according to S&P Global Ratings. Next up for the economy. According to official data published by the People's Bank of China over the weekend, China added to its gold reserves for an 11th straight month in September, as bullion in China rose by 840,000 troy ounces. The World Gold Council said in an October statement that China has seen robust demand this year, which has acted as a support for the precious metal under pressure from rising interest rates around the world. And, finally for the economy, popular China analyst who goes by the online handle Shanghai Macro Strategist posted this chart today, observing, quote, "This is probably the most important chart right now about the Chinese economy. To offset the collapse in the real estate sector, Beijing has managed to surge credit to the manufacturing sector, which has helped to prevent a total collapse of domestic credit growth and demand," end quote. It is indeed an incredibly telling chart, and commentators are discussing its significance today. Quote, "There has indeed been a huge and very interesting shift in the direction of credit. Total credit has expanded even faster than I had expected. The debt-to-GDP ratio will probably rise 9 to 10 percentage points in 2023, even as property sector credit has contracted sharply. The debt-to-GDP ratio matters because when debt funds productive activity, it won't end up in a rising debt-to-GDP ratio. Part of this additional credit is obviously going to local government infrastructure spending, and part of it, included in industrial sector, is going to state-owned enterprises and manufacturers in favored sectors. Given already extensive overcapacity in these manufacturing sectors, along with China's huge trade surpluses, I think this is still part of the shift from the hard budget-constrained parts of the economy to the soft. Some analysts argue that by shifting from property and infrastructure to manufacturing, China is, almost by definition, resolving the non-productive investment problem, but that's based on a confusion over what is productive investment. There is nothing inherently non-productive about investing in property or infrastructure, any more than investing in the manufacturing sector is inherently productive. What matters is whether these sectors are constrained by scarce capital or by weak demand. If the former, national credit can be productive, but if the latter, it's unlikely to be, and even less so if the production is subsidized by transfers that reduce domestic demand. Given the huge amount of capital already made available, along with substantial direct and indirect subsidies, I'm skeptical that favored manufacturing sectors can really productively absorb additional capital in the face of such weak domestic demand. This probably just represents another form of supply-side stimulus in sectors that are in fact demand-constrained. End quote. Okay, that is today's episode of China Update. Like I said, there likely will not be an episode tomorrow on Wednesday, but there should be episodes back from Thursday. Thank you so much for watching today's episode. Have a wonderful Tuesday, and I will either see you tomorrow or on Thursday.